All right, we'll count it down. 3, 2, 1. And this is The Drop. The Don't Retire Graduate podcast is hosted by certified financial planner practitioner Eric Brotman. The pod is dedicated to teaching you how to advance into retirement rather than retreating. Each and every episode will leave you with inspiration and actionable advice. Welcome to the show, Eric.
Thank you, Marcus. Good to be here.
And so you also have the podcast. We're going to focus a little bit on the book today. I want to start with, because I had to look up a few of these acronyms myself, not the certified financial planner, but can you talk a little bit about, you're also an AEP and a CPWA. Can you elaborate on those a little bit?
I can, although you forgot EIEIO. The AEP is the accredited estate planner. And so while I'm not an attorney, I speak attorney. And that is nice. I didn't have to go to law school, but I can do estate planning at a level that has me working with attorneys across the country, which is great. The CPWA is the Certified Private Wealth Advisor, and that's really an education based on working with folks with high net worth and ultra high net worth. So I've credentialed to do from your basic financial planning to your much more significant wealth management.
So that foreshadowing, if you will, that'll bring us, estate planning is in our junior year, because we're going to go through a quick university lesson here. But can you talk a little bit about, maybe at a high level, just in case we run out of time at the back end here, what is estate planning, and why, I'll say, should the average, who I think my listeners are, American, be concerned about it?
Estate planning is essentially a way to not only deal with your final effects when you die, but just as importantly, it's a way to name people legally who can step into your shoes if you're injured, if you're sick, if you need help. So it means creating someone who can, or nominating someone to make financial decisions for you, or medical decisions, who can speak to your doctor or your banker if you can't. And it could be something like during the pandemic, it could be COVID related. If you're on a ventilator somewhere, somebody's going to have to make decisions for you and handle things. And you need to do that regardless of your level of wealth. I think people think of an estate and they think of, the rich uncle reading the will and saying, you get the oil fields, but that's not really what it is. It's for everybody. You want to name trustees for your children. You want to name guardians for your children. Who's going to take care of them if you get hit by a bus tomorrow? And that kind of stuff is morbid. It's no fun, and nobody's bragging about it at cocktail parties, but it's got to get done. It's blocking and tackling.
And to that point, correct me if I'm wrong, because you're closer to the legalese than I am. If you don't plan for it, doesn't the state take over for you? So I guess, what's the risk of not doing estate planning?
Well, the first risk is that during your lifetime, if you're still alive and you need somebody to step into your shoes and it requires a court order to do so, the process of getting through that and just getting somebody nominated to handle that and dealing with the legal system is miserable. So that's true whether you're penniless or whether you're worth a fortune. In terms of the will, yes, the state has a will for you if you don't have one. And if you don't have children, if you're not married, if it's just you and you're footloose and fancy free and you die without a will, no big deal. But if you leave kids behind, or particularly a child with special needs, or if you're married to somebody and each of you have kids from prior marriages, or all these kinds of things, it gets real ugly real quick. And the state has a plan for your assets, and every state's very different too. So it depends where you live. The state has a plan for your assets most people don't want. It's not a good plan. It's just a default plan.
I like that a lot. We're going to pause that right there. That was a good foreshadowing. And we're going to go to the book, Don't Retire, Graduate. So the quote that I want to pull out of there, the book opens with, is, "It's time to retire, our definition of retirement." Ariana Huffington and Huffington Post 2014. So what is wrong with our traditional definition of retirement, and how does it need to change?
Everything is wrong with our traditional definition of retirement. Absolutely everything. Just the word itself. You can't say retire without the word tire in it. The English language, which stems from a version in the UK that's different than the American version we speak most of the time, to retire is to go to sleep. It's to go to bed for the night. When you retire for the evening, you're going to sleep. I don't think any of us want to spend our entire lives building our careers, our vitae, our network, our relationships, and then want to wake up one day and do nothing. And so the concept of retirement is a retreat. It's a surrender. It's giving up and quitting. And essentially, with that kind of definition, why would anyone do it? Why would anyone look forward to that? I mean, I understand the desire to be flexible and to have some free time. But if you go from working 50 or 60 hours a week to daytime TV and shuffleboard, and it could be 30 years of your life, you're in trouble. Like, you got to have a reason to get out of bed every morning, or you will stop getting out of bed in the morning. So I believe we have to look at this as graduating to the next stage of your life. It's something to move towards. It's something to celebrate. And I don't even think retirement's the absence of work. I equate retirement to the absence of needing to work. Financially independent, whether you're 42 or 82, if you're financially independent and you're working because you want to, as far as I'm concerned, you're already retired. You're just active.
I like that definition a lot. Reminded me of a quote from my father. At least you were talking about the 30-year term. Maybe I'm using it wrong. The 30-year term is probably not although he was a probation officer in a stint. So maybe term is the wrong one.
Okay. All right.
But he used to always say to me, and this didn't really make sense until recently. I turned 39 this year, but he used to always say, and I guess he still would, he's still around. He's like, you're old twice as long as you are young. You're old twice as long as you are young. Never understood what the hell he meant until like 39 hit. I'm like, I'm gonna be old twice as long as I was young. And so it makes a lot more sense. So it's hard to wrap around, I think, for people with that retirement. I think it's hard conceptually to think about what retirement means. I think it's difficult for, youth is wasted on the young, for them to think about that stage of life. I remember when I thought 30 was forever away. First of all, I thought 30 was old, and I thought it was forever away.
So did I, except I'm turning 50 very, very soon. And so your 39 story, cry me a river. I don't feel for you at all. When no. You're 39. You're winning Plutus Awards for your podcast. You're kicking butt all over the place. If you're 49 and you're doing that, I say do it at 59, 69, 89. But your father was wise to say that you're old twice as long as you're young. The reality is all of us are finite. And if we live to be 90, which is not an unreasonable thing, because some people are living to 108, which actually sounds mostly horrible to me. But if you're living to 90 and you break your life into either quarters or trimesters, if you looked at it like it was a football game, and you had your first quarter was until you're 22 and a half or 25, and then it's then you're 45, and then you're spending most of your life well beyond your youth.
On the wrong side of 20.
I don't think he should call it a term. If he's a probation officer, he should call it a sentence. It's a 30-year sentence to be elderly at some point.
I'm going to go ahead and transition right here, because I know my audience runs the gamut. So I want to shout you out. I thank you for recognizing the UK listeners. I found out that 1.8% of my listeners are UK. So shout out to y'all from across the pond. And you gave them credit because they do use a superior, I would think they call it, form of English. So I appreciate you for doing that. Hopefully next week it'll be, what's that math? 3.6%. That's based on that bump that I just got right there. And I think that's a good lead into the book. You have freshman year, sophomore year, junior year, and senior year and graduation. Almost skipped a year there, which I would have never done in my life because it took me 5 years. And so, I basically, folks, have to get the book. There's a much more detailed breakdown than the ones that I'm going to hit here. Y'all know how this spill goes. But I pulled out the ones that were of interest to me. You can always open up your own podcast if something else is of interest to you. And I'm going to start with Debt Management 103. So we've already advanced a little bit. And the title is Creative Strategies to Reduce Debt Fast. Can you expand a little bit on the creative strategies to reduce debt fast?
Yes. I mean, beyond the basics of debt management and ordering your debts and figuring out which one to pay first and so forth, I think there are some things that people overlook, some resources people overlook to pay debt down. One of them is equity in various types of assets. And I'm not talking about 401k loans, which I think are an abomination. I'm talking about having access to equity through a home equity line, through a securities-backed line of credit, through a cash value line against your life insurance. I'm talking about intra-family transfers. We've been in such a low interest rate environment for so long that we've forgotten that the generations before us, maybe 2 generations before you and me, but the generations before us who would just as happily sit their money in a certificate of deposit at 5, 6, 7% and live on the interest are now used to 0%. And so there are situations where there are family members who could use more income, and other family members who need the money. So if you borrowed that money from grandma and you paid her 3% on it, she's better off, and so are you. So there's lots of ways to do that.
I'm gonna come back to that, but since you brought it up, now I have to revisit it because I think I feel like it was over 50% are tapping their 401k. So why is a 401k loan an abomination?
A 401k loan is one step down from a payday loan, as far as I'm concerned, in terms of being predatory. And the reason for that is that when you take a 401k loan and you're paying it back, you're paying back pre-tax dollars with post-tax dollars. You're not deducting your interest. So you're not taking a pre-tax deduction from your paycheck to make the loan payments. You're using post-tax dollars to make loan payments to then pay taxes on essentially those same dollars again when you retire.
Okay.
That's brutal. I don't care what the interest rate is. That's brutal. There are better ways. There are lots of places to get money, lots of places to get capital. And that's not to suggest some people aren't in dire straits. And the reason that a 401k loan exists is so that it was done so that people would contribute. There was fear that people would not contribute if they had no access to their money. Okay. So in order to get folks to contribute, they said, listen, if you're really in trouble, you can borrow from it. And that's a hardship withdrawal potentially, or it's a loan provision. They are not good. They're meant to be avoided, really, truly, all the time, basically.
And to the degree that you want to tie into that question, or going back to the equity, the other section that jumped out of me at the freshman year is advisor secrets. Let me hit that one more time. Advisor secrets you need to know. What are some of those secrets?
Well, some of them are the way advisors are paid. I mean, ultimately, understanding how financial institutions make their money is really important. You want it to be transparent. You want it to be fair. You want it to be honest. And so there are things that advisors do. And this isn't to paint financial advisors with a bad brush. There are terrific doctors and lousy doctors. But the financial industry is governed by regulations that really go down to the lowest common denominator. They try and they regulate to the bad apples. And so as a result, everyone is treated like they're bad apples. And I think it's not only onerous for the advisors, but the disclosures can be hundreds of pages long because of all of this. It's kind of like when you spill hot coffee on yourself and the next time you get a cup of coffee, it says caution, contents might be hot. Well, think about all the stuff that can happen in the financial world that's either not above board or that isn't disclosed or that isn't or that has a conflict of interest. They're everywhere. And anyone who says they have no conflict of interest in the work they're doing is probably exaggerating, because there are always conflicts. It's important to describe what they are, explain what they are, minimize them or eliminate them to the extent possible, but to be aware that conflicts exist. It's human.
So with that in mind, or information in mind, what should a client be looking for in an advisor, whether that's questions or how do they avoid the bad apples?
Well, there's an entire chapter in the book dedicated to interview questions that you can ask an advisor. So if you're contemplating hiring a financial advisor, there's a dozen or so questions you should ask anyone you consider hiring. And these questions weren't set up to be booby-trapped. They're not yes, no answers. They're not, this is the right way, this is the wrong way. There's shades of gray every place. This is about understanding how the relationship works. Because I don't believe one size fits all. I really don't. And there are folks out there who say it has to be fee only, or it has to be this, or it has to be that. I don't think one size fits all. I think it's important for the advisor and the client to have a relationship that makes sense for all parties, particularly for the client. And we're not all coming from the same spot here. Somebody 25 and somebody 75, somebody married with 5 kids and somebody single, they're going to need different kinds of solutions. And to suggest that they're all the same is silly.
And that was just freshman year, folks. So, and I skipped around. So I think that was advanced placement that we just went through. Of course, like I said, I'm going to keep plugging this book and we'll get to it at the end of the show. You can find it in your video description. You want to grab the exact link. And I'm going to jump over to the sophomore year questions. And I thought a good one to start off with, although I don't, based on an episode I just did recently about the 5 pillars of adulthood, how 30-year-olds are redefining adulthood with Kayleen Schaefer, for whoever wants to find that episode, is I believe children are expensive. There's a dramatic pause here. So can you expand on that for those who either have children and can't agree, or that need to know about the expenses of children to come?
Yes, having children is a massively expensive endeavor, and it's not just the dollars out of pocket that are obvious. And I'm a dad and a happy dad, and I love my daughter. It's not about whether you should or should not have children. It's whether you can be prepared for it. I've often heard that if you wait to have children until you can afford to have them, you'll never have them. Right. And so it's really about lifestyle changes. It's about things that you have to do. But kids, when we think about the expenses, there's healthcare expenses. You're talking about entire wardrobes from a clothing standpoint. They outgrow them every 6 to 9 months. You're buying a whole wardrobe regularly. Even if it's hand-me-downs or it's secondhand, it still adds up when kids are changing sizes. It's another mouth to feed. But these are the little things. It's the education. The education, oh my goodness. If you live in an area where you can rely on the public schools, that's great. But a lot of people don't. And so when you have to start looking at other types of education, and it includes tuition, that is an unbelievably unnerving number. I'm in the Baltimore metro area, and the private schools are everywhere here. And having a child in private school is a major financial commitment. And then there's college, which not everyone goes and not everyone should. But if you are intending to try and assist your children with college planning right now, the cost of that it's mind numbing. And what I don't want to see for my own daughter is I don't want to see her graduate from school with massive student debt because she's starting in a hole. I mean, I'm sure you've had people on the show to talk about that. You start your professional life, you start your adulthood, not at 0, but at a negative number. And so that's not good. Kids also affect your earning potential. And this isn't a gender thing. It's not a mom or dad thing. It's that when you have a sick kid, you might need to be home. If you're not able to do that, you might be talking about daycare or a nanny or other types of expenses for that. If you're in a situation where, let's say you're widowed. If you're in a marriage and your spouse were to pass away and it's just you and there's no children, that's a financial issue, but it's not devastating. If you become a single parent, it changes everything. And so it changes your ability to work the way you've worked. It changes your ability to make decisions the way you have. And so I think children are wildly expensive. I would estimate somewhere around $1 million of total net worth per child. And that's why couples, and we represent lots of folks across the spectrum, across the country, couples without children tend to be, at least on paper, wealthier, significantly wealthier than couples with children because their priorities are different. And that's not good, bad, or sideways. It's just true.
Yeah, and the guest that I would highlight that spoke to that is Generational Wealth with Kevin Matthews. He has 2 children. I'm sure he's crunched these numbers as well because he's a financial advisor. But what he talked about is he's already buying assets, primarily, at least what we talked about, stocks for his children. And he said his aha moment actually happened when he was an intern on Wall Street. And he was looking at the index tables and he saw that if his parents had invested $83, if I remember correctly, up until that point, he would have had $810,000. They didn't, and he didn't.
Right.
And so he said to himself that he will not have his children asking that what if question. So if you want to learn about how to actualize that through generational wealth, in addition to this, since you're already on the podcast, go back to Kevin Matthews' Generational Wealth if you skipped over that one. We're going to come back, foreshadowing a little bit here. I'm actually going to stay in the sophomore year, and so you can continue to listen. It's Financial Independence, the Art of Portfolio Design. But as y'all know, this season is Employee to Entrepreneur, so I'm paying some bills around here. Give me 15 seconds of your time. 1 in 3 Americans have $0 saved for retirement. Former guest Jeremy Schneider wants to do something about it. In just 8 steps in less than 15 minutes, Jeremy's How to Build Wealth with Index Funds course taught me how to start investing, choose the right investment, and open a new index fund with Vanguard. I am not only a promoter, I am a student. And you can watch that interview live at themarcusgarrett.com/investwith/personal finance club, or scroll down to your video description or podcast wherever you're listening right now. And we're back. Still in the sophomore year, had to pay some bills around here. Thank you for continuing to tune in. And we are at financial independence, something I know many of you know and love, I should say. And the one that I want to call out here is the art of portfolio design. So we've already talked about children, those little crumb snatchers snatching away at our wealth management. So how do we get our art of portfolio design to account for these factors in our lives?
Well, I think the first thing is to understand that some of the rules of thumb that we've been, if not taught, we've been subjected to over the years of our lives aren't necessarily, they don't necessarily fit. I mean, I say one size doesn't fit all about so many things. This is another one. Your portfolio needs to include different elements based on your life, your income needs, your tax bracket. It's not just about picking the right growth fund or the right value fund or the right manager. It's really about asset classes, and it starts there. And there are folks who would say that you start with an equity portfolio, and you have a real estate portfolio, and you have business interests, and there are lots of different ways to build wealth. But from a purely investment portfolio standpoint, there are only three traditional asset classes that are included in most indices. It's stocks, bonds, and cash. And we're at a point in the world where equities look expensive. I don't know whether they'll prove to be or not, and I have no crystal ball either, so I'm not predicting the future either. But there are indications that particularly U.S. equities could be expensive. Bonds are in harm's way. I mean, bonds did so well for so long because interest rates just kept dropping and dropping and dropping. And now we're seeing inflation. We're seeing inflation impact that. We're seeing interest rates rise. That's going to hurt bond prices. And you still can't get a decent yield in most bonds. And then cash is paying nothing. So that your traditional asset classes can't by themselves do the job.
Yeah. I know that I've seen that painfully with cash. I only get emails telling me that my high yield account is going down. But my question was actually going to be, if we can expand a little bit on bonds, at least it's of interest to me. Mm-hmm. And I say that because I feel like a decade, if not my entire life, especially, my generation, so to speak, senior millennial, geriatric, if you ask some people. So geriatric millennial. And that is, I haven't heard anybody advised to invest in bonds in this kind of space, and your influencers and your TikTok. And there's a whole nother spill you could say about that. Yesterday, and I feel he wasn't the only one, but yesterday I saw somebody's like, you got to get bonds. So why are people either re-interested in bonds or growing disinterested in bonds? I want to expand on that a little bit.
Yeah, first of all, I have no idea what kinds of bonds were being addressed in that particular statement, but
it was now I might get it wrong. I favored the videos. Perhaps I can get the screenshot when I release this episode. But it was treasury bonds, if I remember correctly, and he was saying that it was now I might sway on the percentages. I think it was 7%. And then they were going to revisit them in April. So I was like, oh, I mean, that's a decent rate, But I guess still my question is, like, we weren't talking about bonds. I didn't hear anybody, and it feels like we are again.
There is a provision right now for Treasury Direct bonds that is a very small limit that can be held in artificially high interest rates. That's a temporary condition. That's not a normal thing. I would say right now, most bonds, particularly longer term bonds, the longer your duration, the more they're going to vary based on interest rate adjustments. I think most of them are in harm's way. And now there are some exceptions to that. First of all, there are ways to use debt where you're not lending at a fixed rate. I mean, think about it. If you were buying a house right now and you needed a mortgage and your interest rate was 3% or 3.5%, would you want to buy with a fixed or a variable note?
I'm going with fixed.
Correct, because you're borrowing while you've got it low. But if you're lending, the shoe's on the other foot. You don't want to lend. And when you buy a bond, all you're doing is lending money, whether it's to a government, a municipality, an agency, a company, you're lending money. When you lend them money at a fixed rate, long term, and that rate is abnormally low, or the prevailing rates are going to go up, the bond value is going to drop. Now, you might still get your interest. If it's a high quality, you're still going to get your interest. But if you and I were both sitting on $10,000 and we were going to go buy a bond with it, and I already owned one. I bought it and it's 3%. You now have the ability to either buy my bond with a few years left on it at 3%, or you can go with that same 10 grand and buy a 5% bond. You're either going to buy the 5% bond or you're going to offer me less than face amount for my 3% bond, which is why the values will drop. Now, there are some inflation protected treasuries. That's not a bad thing because you can take advantage of interest rate rising. I think it's a good time to lend variable rate. That means private debt. It means credit.
Okay.
So there are ways to use debt to make money as part of your portfolio. And I don't mean leverage. I don't mean you're borrowing. I mean you're lending.
Yeah.
But for the most part, people who get wealthy aren't, they're not the folks who lend money. They're the folks who own things. And so there's a very different level of wealth generation. So bonds were historically considered safe. That should be in air quotes too. It's the safe answer, but right now they're not safe. And cash is paying less than inflation, much less. So if you're earning 0.15% in the high yield account versus 0.02% in the not high yield account, but the price of eggs, milk, and gasoline are going up a whole lot more than that, you're falling behind. You can't hold a ton of cash. Cash is an emergency resource. And it over time, it can be an asset class, but right now it's not attractive.
I don't think this is a change too much. So if it is, and we need to expand on that a little bit, just let me know. But for the folks keeping track at home, we're moving into the junior year. The one I called out was risk management and protection. So it sounds like it fits in this category. But what I grabbed was defense against the dark arts of aging. What do we need to keep in mind as we inevitably, as we talked about earlier, age?
Well, first of all, I think it's important to know that we are going to live longer than we expect. And life's going to be more expensive than we dreamt. Honestly, that's the partly because if you think about what we budget for, there will be things in our monthly budget in 10 years or 20 years that feel important in our monthly budget that don't exist today. And for proof of that, I would tell you, when you were 15 years old, your family budget did not include an internet service provider or streaming services or any of the kinds of things that we now consider part of our monthly nut. We were paying per minute for long distance phone calls, but I digress. There's going to be things that change, plus and minus. So life's going to get more expensive. Healthcare is going to get more expensive. Leisure is going to get more expensive. And the odds of us living, a married couple with two spouses in their who are 60 have a really good shot of one of them turning 95. And that's a long time. A lot of people tie how long they think they're going to live to how long their parents live. But their parents grew up in a time where medical care was different. Some education was different. I mean, there was an ashtray on every desk back in the day. Like some of it is just, some of it is habits. There wasn't organic produce. There are things that people can do. The supplements, the awareness, the access to fitness. Things that are going to make us all live longer, plus the advantages and the technology in medical care.
So, and I wish I had the quote that I could tie in. It's from that same conversation with Kayleen Schaefer, the journalist from the New York Times, for folks who want to find that episode and this quote that I'm about to butcher, which is why I'm telling y'all to go listen to that episode. But she said part of her interviews was with a doctor, and I think he might have also been speaking financially in this particular circumstance, but he was saying that, yes, we're living longer. Thus, the milestones in this case were shifting from millennials and Gen Z. Thus, that's why they're accomplishing things later. But the positive spin on that he had on that is that also gives us a longer timeline for, in this circumstance, I think, portfolio adjustment. So are you saying that, or do you have advice for, okay, let's say 90, if that's because you're right, that usually I'm hearing 67, 78, but if we're talking 80, 90, how does that change either our mindset, our portfolio? Like, what do we do with that information?
The length of time that we're going to live is one of the two primary factors. The other is the length of time we're going to earn, because there are only three kinds of people in the financial world, in markets. There's buyers, holders, and sellers. And we go into this in the book. The buyers have a certain behavior that you can take advantage of volatility. Folks in their 20s, 30s, 40s, the best thing that could happen to those folks financially from an investment standpoint is to have another 0809. I am not rooting for that, nor am I calling for one. I'm just saying that when prices drop 40% and you're buying every paycheck, ultimately you're going to benefit from that. Yeah. Now, holders, we look at the great financial crisis. Holders are not adding every paycheck, but they're also not withdrawing yet. These are folks who often are in that 10-year to financial independence target. And those are the most at risk of everybody. Because if you're a senior, you've already ideally positioned yourself to create income. You've already positioned yourself to avoid unnecessary market risk. And if you're a young person, bring on the market risk. Let's grow this thing. But if you're in between, those are the folks who got crushed. That's part of the reason why after the great financial crisis, people had to work longer. They had to work 5 extra years just to make up for lost time, which meant there was no job turnover, which meant there weren't new jobs for millennials. And it like snowballed in the economy because of this event. There's to me, there are 3 different primary strategies for creating income. And, I detail them in the book, but functionally it's a total return strategy, an asset segregation strategy, and an annuitization strategy. And they're all different, and they all can be used interchangeably for different households, for different situations based on age and health and marital status and so forth. One size never fits all.
And there was 2, one wasn't technically a term, but 2 things I want to revisit just in case first time folks hearing them. You had mentioned earlier a monthly nut. Nut is an acronym. My business coach mentions it all the time. Half the time I know what it means, but is that an acronym, or can you explain that?
No, that is slang probably. The monthly nut is your monthly budget, what you have to cover, your bills you have to cover every month. It's funny. I've been saying that for so long. I don't even know where it came from.
Yeah, he uses it all the time. And,
no, I don't think.
Generally, I just use the context of the conversation. I'm like, okay, I think he's talking about this.
I don't think NUT stands for anything that I'm aware of. So there's that.
There was that. And then as far as why, as far as the younger 20-somethings would be looking for that 40, not looking for, but would benefit from that 40% drop is because that's a market correction. Actually, that'd be over a market correction. Usually 20% we're going into bear. And then because the market is on sell, correct? It's like why I think is wrapping their head around why that 40% drop would be a benefit to them.
Because your accumulation years are more ahead of you than behind you, and because you're buying. I used to joke, and Macy's is hard to find these days, but I used to joke that when there was a sale on linens at Macy's, there was a line around the building at 4 a.m. But when there was a sale on Wall Street, people thought something was defective. If you're buying good companies and you're getting a better price for it, good for you.
I was going to say,
I'm getting very excited.
First of all, I still shop at Macy's. I got Macy's card, which I pay off every month. Every month that I use it.
Yes, because
I could hear the keys. I could hear the keys in the background. Like, he has a Macy's card. So I was like, let me offset that.
Don't. Yeah, exactly.
Now, mind you, I never worked at Macy's. My fiance did, actually. I worked at JCPenney, which is, we were talking about the difference. She's like, yeah, and you had to have solid black pants, and the clothes had to be stacked 4 inches high, and people would come over and measure. I was like, JCPenney, we were just trying to keep people from stealing our dollar trousers. So I was like, different philosophies. So there's levels.
JCPenney, that catalog was part of my childhood. Because that was where you circled all the stuff you hoped you could ask for Christmas. That was real. And I was, at 6, and it was 500 pages long of stuff.
I literally just had one of those six Sense flashbacks because technically I worked in a call center, but we would do, and we talked about this earlier, we would do readouts for AT&T. So I sold long distance service, and it would tell you in the beginning AT&T or JCPenney. And I would also sell I would sell out of the catalog for JCPenney. So, been a dual entrepreneur all my life, folks. It's been about this. I'm talking about I was still in college. So this was my early 20s. So I've been in the game for a while, and I've been about this life. I didn't just show up and try to market off y'all like these TikTok influencers. I'm about this life.
Ooh, shots fired.
I can put it right there in the resume.
Shots have been fired. Okay, fair enough.
I'll put a screenshot of the resume up.
All right.
And now I think this is a good time. Maybe people are growing tired of this conversation, but I'm having a great time. We're at our senior year. So folks, if you're winding down, you've made it to senior year. And I'm just going to pull this one right out. It's 401 financial independence. And you say being wealthy in quotes. Why in quotes, or what is wealth?
You tell me. The reason that I put it in quotes is because there is no definition. Everyone's definition is different. You know, I once heard the great philosopher Chris Rock quip that if Bill Gates woke up tomorrow with Oprah's net worth, he'd want to jump out a window. Now, and I'm butchering his quote, so sorry, Chris. At the end of the day,
if Chris is listening to this show, you're welcome to butcher.
There you go.
Butcher away. Yeah, we've done something right. If Chris is like, man,
well, we can get him on. I'll debate him about anything he wants. The reality is, what he means that wealth is relative. There's a Bulgarian proverb that says being wealthy is having more money than your neighbor. I mean, what is wealthy? And think about the term wealth. There's lots of kinds of wealth. It's not just money. It's not just stuff. There's a wealth of experience, a wealth of knowledge. There's ways to use that word to mean abundance. Well, abundant for you and abundant for me, intellectually, or emotionally, might be different. But the number is kind of irrelevant, right? I mean, you're going to have a different feeling about what abundance is than I am. What's it mean? So I think to be wealthy, in the simplest term, is to not have to work for any money anymore. Period. If you and whether you're fire and you're 37 and you've lived a minimalistic lifestyle and now you're reaping the rewards of that, or whether you're 75 and you've collected Social Security and an old school pension and have some savings too, how you get there, when you get there, to me is less important than that you get there.
And probably not too many on this show, but for those hearing that for the first time, it's Financial Independence Retire Early. There's several remixes, Financial Independence Remain Employed. And then it seems like, because you always got to have something to fight about on the internet, it seems like the most recent fight is a Coast Fire. And I can't even remember the other one because I'm not involved in the fights. But I found Coast Fire pretty interesting. The general concept being that you basically race until your maximum retirement number. Typically, people use 25 times your, I think it's expenses actually for Coast Fire.
Yep.
And then that's your coast. So if you hit your, let's say 500,000 was your coast, you'd hit 500,000 by age 40, and then that would continue to grow in your investments account, and you coast for the rest of your, actually, in that case, I guess you're not retiring, but you've hit your retirement goal because that amount would grow in your vested account.
Well, if you're talking 25 times, and I don't know that reference, but if you're talking 25 times, that means a 4% withdrawal rate, 4% being the rule of thumb.
Yep.
But we've talked about rules of thumb. 4% works great until it doesn't. All right. And if you happen to be one of those unfortunate souls who retires, or whether you've quit your job or whether you believe you're coasting and it's 2007, 4% is going to look a whole lot different after market corrections or economic changes. It's really also not about just 4%. It's got to be 4% net of expenses. And ideally, it needs to also keep up with inflation. So if inflation's 2%, and you're pulling, and you need to earn 6% on your portfolio. If inflation's 2%, for you to live on 4% and still maintain your standard of living, maintain your dignity. If inflation is suddenly 6%, then you suddenly need a 10% return to take a 4% withdrawal. I don't know where you're going to find that, but you can manage my money if you promise you will.
You struck a nerve there, not for me. They'll leave a comment. This is your opportunity to leave a 5-star review if you know an asset class that can return greater than 10%. I know exactly which individuals will show up.
I'll be anxious to look at them. Yeah.
So we'll end with rounding towards graduation day, retirement readiness. I think you spoke to this, is the option basically to make work optional, but preparing assets to create income. What does that mean?
That is a complete mind shift from what we've been doing for 30, 40, 50 years of our adult life. Building the mountain chart is the easiest thing in the world. The math to build and accumulate money is so simple. You put X dollars in, you earn Y return, you do it for Z years, and you have so much money. That is arguably a very simple equation. But the equation when you start talking about income is totally different, because some of that income is capital gain, some of it's ordinary income, some of it's a dividend, some of it's an interest payment, some of it is subject to various tax rules or age restrictions or liquidity issues. Some of it is tied to your residence. Some of it's tied to other things. So figuring out where you're going to get the income and doing that is a completely different skill set. And it's one that most people have never done before because you only do it once in your life. You know, if you've taken a new job and you're 35 and you'd already done that once before at 30, you know how to change your employee benefits or elect your 401k or make the decisions you need to make. You know that you're putting away 6% or 8% or 10% of your salary. You know how to do this because you've done it over and over and over again in your life. What you don't know how to do is how to turn that bank statement or investment statement or net worth sheet into sustainable lifetime income. How do you do that? And so it means making sure assets are prepared for that. It also means you got to be prepared for any market. And so that's when we talk about things like asset segregation. Which dollars need to be available to you in the next 5 to 10 years? Let's treat them one way. And which dollars don't need to be accessible to you in the next 5 to 10 years? Let's treat them very differently. Because the ones you're not touching for 5 to 10 years, you can continue to allow for some volatility. I'm not saying be a rock star and speculative. I'm saying you can handle some volatility if you don't need the money anytime soon. But if you need that money to pay the bills or to circle back to manage your nut, if you've got to do that, you got to make sure you know where it's coming from. It has to be predictable. And so preparing your assets for income is a very important step. And it is just to glide into graduation. You got to make sure you do that right. Because in a lot of cases, there's no mulligans. You know, you elect your Social Security and you live with it. You elect a pension, or you elect survivorship benefits, or you make decisions around life insurance or other types of things. Sometimes once that ship sails, it's done. There's no do-over. So, and we've seen so many mistakes where people tap a 457B plan with a small amount of money and then they're not allowed to change the amount of the draft ever in their lifetimes. And the summary plan description was confusing, but it was also legalese and you have to go through it. And so many financial vehicles are booby trapped. They really are. You talk about annuity contracts. You talk about various types of investments that are illiquid, and they are full of pitfalls. And that's not to say they're good, bad, or sideways. You just have to know how to use them.
I like it. I think we've thoroughly drawn the people in. The book actually wraps with final thoughts and congratulations. Now what? I think we just hit that, but anything that you want to highlight for the wrap, and where can people find you in the e-streets?
Yes. First of all, it's about creating a legacy. It's about things that are more important than money. It's about the conversations you have with your children, your grandchildren, your other family members. It's about leaving behind a true legacy, and it's never stuff. It's not stuff. You know, families fight over who gets the chafing dish and it ruins Thanksgiving. I don't get that. It's not stuff. It's legacies, it's values, it's visions, it's stories, it's laughter. So there's much more to the book than just the math, because frankly, the math is easy, but it's also a little boring. So the book has to be fun and engaging to get you to take these things. So that's first. Second of all, in terms of finding us, the book's available on Amazon. I have 3 books that I've written over my career, but this is the one that I would tell folks to pick up. It's up to date, and it's I think it's the capstone of my writing career. So you can find it also at brotmanmedia.com. You can find our ebooks, our white papers, financial literacy courses, some of which are free and available to anyone who wants to take them. So lots of resources. We really want people to be armed to make good decisions.
And where can people who are listening or watching find this podcast?
The podcast is at don'tretiregraduate.com or brotmanmedia.com. And it's on Apple and Spotify and all the different sites as well.
Cool. I think it's been an engaging conversation, and thank you for coming on the show, Eric.
It's been a lot of fun. Thanks for having me.
And fake fade to black.